Thank you all for being here. I'm Alejandra Martinez. I work at Foundation Capital, and I invest in early stage companies in crypto, mostly crypto, some fintech, although our worlds are definitely colliding. So doing pre-seed to Series A deals. Today, we're going to be talking about what really survives in crypto when global liquidity tightens. We have 4 fellow panelists over here, so I'll let them introduce themselves. And we're going to just kick off with setting the baseline. What is your current posture about liquidity tightening right now?
Awesome. Thanks, Alejandra. My name is James Kibbie. I'm a principal at Galaxy Ventures. We're an early stage venture firm investing in the convergence of fintech and digital assets. And I would say our posture is that we're investing for the long term. And so looking for secular trends that will survive global liquidity tightening. So I think right now is an interesting time for founders to focus on building, and we're not as exposed to the short-term liquidity tightening.
Great, thanks. Hi guys, my name's Nauman Sheikh. I run treasury management at G20 Group. G20 Group is a cross asset class quantitative trading firm and asset manager. Very macro focused as well. So I have a pretty decent sense of where liquidity is at the moment and where it's been. Our personal view is that on balance, globally, we are actually in an easing phase as opposed to the tightening phase. On the margin, yes, we're tightening just because of commodity prices and geopolitically and oil, and that has a danger of seeping into inflation numbers and a potential tightening phase as well. So that's a danger zone. But at the moment, you can see from the market performance at the moment, we're actually liquidity positive. So,
hello, everyone. So happy to see you all, and kudos for you for staying for the last panel of the day. So, yee-hoo! For you guys. So my name is Saul, Rejwan, managing partner in Masterkey VC. For Masterkey, it's a term in cryptography, basically to produce keys and to protect them. And that's exactly what we do, backed by 16 cryptographers, PhDs, professors. So basically we have a PhD that leads each segment of cryptography. Other team members are working on BizDev and etc. So we're like very niche on our segments of investments. We're looking for the deep tech cryptography in that. And we're super bullish on this space. Been over 12 years full-time in the space, and I can tell you that I've never been bullish like that before. Mainly not just because the adoption institutions, and we're going to talk about that in liquidity part, etc., but also about the technology readiness and what we see in the intersection between AI, and it's required different cyber tools. It's required also different type of verification that only cryptography can solve. And yeah, that's me.
Hi everyone, great to be here and welcome to the graveyard slot that we have here. I lead commercial efforts at the Algorand Foundation and also our investing activities. I mean, a lot of the comments here on global liquidity, I tend to agree with. Although as a foundation, we aren't typically exposed directly to global liquidity cycles. I think as a layer one protocol, we're a bit of a beta, but in terms of our day-to-day activities, they don't change. Quite frankly, we have a focus on driving adoption and advancing the technology of our protocol on a day in day out basis, but general liquidity cycles less so. And I have some views on how that affects a lot of the types of protocols that we have on Algorand, but we can get into that a bit later.
I think it's interesting when you just think more about the comments you all have been making and our posture as well. I think that there's a reason that we've been around in crypto for more than one cycle, right? I think for a lot of it is we do think about this tightening, but it's kind of you just business as usual, right? And you just keep building and kind of just solidifying the foundation for a lot of what we're trying to do here long term. And so if there's something there's something optimistic to take away from the way that we're opening this up, it's that there's a reason we're still here. And so just taking it back to what you would actually see as some signs of tightening happening, and which segments are most exposed to that we kind of need to protect during these tightening cycles?
Yeah, sure, and I can take this. I think the market has already gone through a stress assessment as it is in the last few months. Actually from October onwards, when we had the cascading liquidations and that into the February cascading liquidations, I think that the market tends to identify which are the winners and the losers as it is. And I think this tightening cycle, or whatever you want to call it, liquidity tightening cycle, has also done that. You can clearly see which ones are the winners, which ones are the losers. And, the altcoins that have really zero fee generation, zero TVL, or just the ghost coins that you see out there, they're slowly bleeding away. They've been kind of underperforming. Then there are sectors that have structural bids to the market. Bitcoin ETH, from corporate treasuries and DATs and ETF. They're not going to see such a huge drawdown. Whereas it's other sectors that are winners, that the perp dexes and the RWA theme and the stablecoin themes, you can see the clear divergence when that happens. So I think we're in that cycle right now where there's a clear differentiation, and then but also the market has identified where there's value, where there isn't value, right? The value has clearly gone to companies or protocols that generate these revenues and fees as well.
Yeah, but I also, sorry, I want to add to that. Liquidity, it's kind of like a very abstract, like it's something that is really embedded in our ecosystem, because tokens are in the front and people are like looking to trade different type of tokens and NFTs and things, that it's like the next hype or something. But the liquidity issue is not just there, it's also on the other side of like traditional companies that actually have sales. We see in like the last look on most of the AMA in our space, these are all equity chain replace. So like none of them is actually coming with cash. So the liquidity issue in the space might been seen or noticed mainly in tokens, but it exists also on the other sectors. Most likely, things will change, because one thing we see, it's like, of course, the Bitcoin cycle, and the Bitcoin cycle have never been performing in a positive or like such a high interest rate. So that's also one thing that it also puts a lot of liquidity on the fence. We need to be like out of the space or like everywhere in Earth, because in the last 3 years, the most dominant technology was AI, and everything that's related to AI kind of like sucked down all the liquidity and gunpowder from a lot of other industries. On the other hand, look what's happening in the States, right? Today we have an advisor to the government that is leading blockchain or digital assets and AI. So like the priority is there in national understanding. So it's just a matter of time until the next bull run. We will see these gaps are being closed very, very fast. So like that's even a bigger opportunity of our space these days.
Amar, I'd be curious to get your perspective from someone from an L1 that also has a pretty developed ecosystem. What are some of the rotations of capital that you see?
Yeah, so I think we really are entering a post-speculation era for blockchain infrastructure just going forward. I think the last 8 years or so, there has been a big push for why blockchain infrastructure, and a lot of that has lent into read, write, own culture, and really just speculation on various types of crypto assets, whether that was initially the foundational protocols that were launched, and then we went into the phase of NFTs and owning sort of gaming assets, and more recently meme culture. I think there's now just enough pattern recognition of what we call retail or just general perception of blockchain infrastructure, that it's just doesn't work. There isn't really the desire for the general populace to want to buy into something completely speculative, like a Iggy Azalea meme coin, or really just something specific regarding owning a digital art or a gaming asset. And I think we've seen that over the last 6 to 7 months, and that's why crypto as a sort of overall asset has really struggled. But I think we're coming out of that now, and for us, I think that's great, because we don't really play in that space as much as other protocols, and we're very much driven to have Algorand as a protocol used for its technical capabilities as an underlying blockchain layer. It doesn't need to be for a Web3 product. It probably makes more sense for it to be for an infrastructure layer for Web 2.5 applications or institutional applications. And so that's really where I see the move now. And I think you can see that as well, where people talk less now at conferences about crypto and more about digital assets. And I've seen a big creep in the number of suits at conferences over the last 12 to 18 months as well. And so I think it's definitely a different reality that we have to accept as an overall ecosystem of blockchain.
Yeah, definitely a completely new phase of maturity, right? And with that comes a difference also in just new talent for many of the things that we end up investing in. And so, James, a similar question to Amar for you. I think it's a little bit different the way that we think about new investments versus the way that we think about our portfolio in moments like these. And so for now, let's just focus on the portfolio piece. Kind of what are some of the struggles, as liquidity changes so dramatically in an environment like this? And what do you advise your portfolio companies and how to manage it?
Yeah, that's a good question. I think the first thing that we see across our portfolio companies is when liquidity tightens in crypto, it becomes very clear who's serving which customers, because we have companies in our portfolio who primarily serve very crypto native customers who are highly exposed to crypto asset prices. And then we have other portfolio companies that are leveraging this like technology and applying it to solutions for the broader world. And I think in the first few months or quarters of tight liquidity, we start to see that show up in the revenue numbers. So companies that are continuing to grow with no real change in their growth rate tend to be the ones that are serving the broader population. And then for the companies that see a stagnation in growth, or where revenue starts to fall off, or if it's a DeFi protocol where TVL is falling off, that's when we'll kind of spend time with them and think about how they can expand their user base, and try to find ways to, what did you figure out over the first year, 2 years of building this company that could be applicable to a new audience of users that might be a little bit more counter-cyclical to crypto asset prices.
Yeah, just on top of that, we speak to a lot of founders as well from a treasury management perspective, at least at the stage where they TG, they're out in the market, going public. We try to advise the founders or save them from their own greed at that point in time, because we've seen cycles over and over again, bear cycles, bull cycles, especially in the crypto space. They consistently have this really optimistic view on where token prices are going at the expense of their own balance sheet, right? So it's always, an advice about just making sure that you solidify your runway. You do whatever you need to do on the treasury front, because you're gonna need that balance sheet to survive for the next 5 years. So our advice is constantly to these founders: just make sure you do that, and whatever way you can, whether you're selling tokens or whether you're overlaying hedges or whatnot. That's common advice.
Yeah, there really is no way of predicting where the market will be when whether you're even pre-TG or post-TG, and considering a sale of some of your treasury. And so, yeah, we have a very similar stance on just kind of expect the worst, hope for the best, and kind of manage with that in mind. I did say I was not going to go rogue on questions, but what some of the points that you're bringing up do make me think about this kind of just common but important question of apps versus infrastructure and whether there's a different approach for each of them. There's definitely a trade-off with sales cycles and retail liquidity based on what you were saying. So curious to get all of your takes from the different perspectives that you have on this question.
I will jump. So I will be happy to ask the audience here, what do you think about blockchain? Is it for humans? Okay. So like, if anyone here traded NFTs or like meme coin?
No one will admit that.
Okay, no, that's cool. I'll tell you that. So like basically my thesis about blockchains that it's not for humans layer. It's literally was created for agents. Like now we have the answer. We understand it. It's easy to see it. But how many people are like excited to hear that, I don't know, they're using Google Maps and Google is using MongoDB database? No one cares about that. And that's exactly the same thing. Or like when you're talking about the infrastructure or apps, I believe that we're still building the infrastructure. Like that infrastructure is not running smoothly. It's not existing in so many applications. We do see it coming massive adoption from stable coins, from prediction markets, from more and more use cases, but payments is one of them. And, it's kind of like going back to the original thesis of Bitcoin. What is Bitcoin all about? What to do with it? Yeah, it's a blockchain, closed, centralized. The world don't care about it, but the adoption is coming. In my point of view, we're still not in the phase to even think about the apps because we still need to make sure that the infra will run on it.
I mean, before going to the next person, I think it's an interesting take. At the same time, it's like the apps give us such a strong feedback loop for where infrastructure is. I think one of the struggles with crypto sometimes is just not having that proximity to the customer when one is building and what to prioritize and what will actually work. And so we can spend so much time building in this infrastructure that ultimately cannot get adopted fast enough, and then we run out of runways. And so I feel like that's one of the real risks that we have when we aren't doing a little bit of both.
Yeah, I would agree. I think apps are very important for the feedback loop, like Alejandra said, because it helps you determine. You'll often see founders that overbuild and they want to get the product perfect before it goes out to the consumer, or if it's a B2B business going out to the business. And then if it's overbuilt before it goes to the business or the customer, and then the business or the B2B client or the consumer client says they don't like what, the way it works, or they give a recommendation, they say we want it to work this way, and the infrastructure is kind of set in stone in a way where it's hard to change and it's hard to adjust, then I think you end up in a tough position where you have this really solid infrastructure that doesn't really serve a customer purpose, and the customers aren't happy. So I think getting to market quickly with a product and then finding a core user base that likes the product, finding businesses that like the product, solving problems for them is a necessary. I think we're kind of at that point right now where there's been a lot of infrastructure built, and to the credit of the infrastructure builders, the apps that are being built are finally useful to consumers and to regular businesses.
And the interesting part about that too is like you see infrastructure teams actually doing some experimentation with apps as well. Sometimes when adoption can't come fast enough or liquidity isn't there, I feel like I'm seeing that more right now than in prior years of just like, let me prove this out to myself, and it makes it an easier sell too. So there's another question about U.S. liquidity versus global liquidity. I mean, not all of us here are based in the U.S., so I'm curious if your answers are a little bit different when you think about the source of the funds.
I mean, if you have to compare global liquidity, I mean, just I guess see what happened during the crypto sell-off. The U.S. or the U.S. clients pulled liquidity at the time. The Middle Eastern clients, Asian clients were very, very much still there. Okay, I think it has a lot to do with maybe the dollar as an alternative currency, or trying to position in an alternative asset or currency. So I feel like if you look at the global picture, there's always a steady hand outside of the U.S. in terms of liquidity picture. On top of that, we rely on China to a very great deal in terms of providing liquidity to the market as well in general. So they're in a moderate sort of easing phase right now, which is helping capital markets overall. So is the U.S. It counterbalances a lot of the other countries that are actually tightening, right? That's why I say in the beginning, we're on balance in a liquidity phase or an easing phase, which is helping markets globally, is helping crypto markets. Crypto markets, if you think about it, didn't suffer from tightening liquidity, suffered from liquidations at the end of the day, just structural issues. And it took a long time for that to come back because all the liquidity, all the investment dollars went into equity markets, AI. And why? Because it's actually supported by real earnings, right? And that's why we continue to see a rally and record levels in the equity markets and not in the crypto markets. Now I feel that that's turning now because the risk is slowly being reduced. We just have to, get rid of the or eliminate the geopolitical risk, and then we'll see a rebound.
So if we're talking about global liquidity, I'll tell you a little bit about the way we see it in our fund. Few things affect dramatically in the last few years in our industry. First of all, it's the changes in the interest rate. Second, it's the fact that there are DATs out there. And then if in the past people want to get exposure to Bitcoin, they just went to an exchange, Coinbase, for instance, create account, bought Bitcoin, 2 weeks after bought a little Ethereum, but converted to another meme coin, lost money, like we all know how it goes. Now they're just going into their brokerage account and buy Marathon, or they buy, what's the name of that? Michael Saylor's. Anyway, well, you all know strategy. That's what people do now. They want to buy Ethereum. They just buy it from brokerage. They don't buy it on chain anymore. So we see like massive amount of liquidity shifting. And that's actually when we're discussing about like why we believe it's still in infra and not in apps. Let's look what's happening these days in DeFi, right? Like in 2020, 22, there was like the DeFi summer 21. Everybody were so happy. I really believe that we need decentralized finance. But today, the decentralized finance shifted to Wall Street. So if you want to do something with your tokens, you basically go to your brokerage, you're getting loan against it, not through Aave, but directly from your bank. And it's basically another thing that we noticed, that it's like DeFi, it's a massive opportunity on Ethereum. You can't copy it to Bitcoin. The Bitcoin guys don't want it. So like different segments want different type of products, require different type of infrastructure. But when you're looking on institutions, or like institutions, they just can offer in a very centralized, simple way, if sometimes even wider opportunities that are more easy to understand to the retail, that's what they want.
So to close off, based on all this discussion that we've been having, what would be a category that you would be excited about right now?
We are very excited about really driving. I think what we've seen over the last a couple of years now has been really interesting applications of tokenization of real world assets, different types of assets that typically have not been either readily accessible or available in sort of micro form to the masses. We're seeing that now, whether it's private funds or real estate or private credit funds. There's a broad range of types of assets that we're seeing that have been tokenized. But I think the big stumbling block over the last year or two has been that there hasn't really been the take up of those assets. A lot of that is in part due to a lack of distribution of those assets, a distribution of those assets to end holders that have a desire or a need to want to sort of hold those assets, whether it's US treasuries or whether it's tokenized Tesla stock. That's where we're focusing on. And our big focus really is in emerging markets. And so we're working with neobanks, traditional neobanks, crypto neobanks, some of the incumbent financial institutions, and some exciting super apps that are popping up in Thailand and the Philippines, and really providing access to these assets. And so that's something that we are very, very excited by, because this is where we see the biggest opportunity, because there's the biggest leap of a need for tokenized assets in these markets.
We're running out of time, so the 15 to 30-second lightning response from the rest of you.
I will say that we're super bullish about post-quantum cryptography, agentic payments, more infra for Web3, tokenize everything, but just make it better with cryptography.
Yeah, I'm going to echo that. But in addition to that, I would say just perplexes in general that trade real world assets. I think they're going to grab an enormous share, even away from crypto assets, more into the real world commodities, equity indices, fixed income indices, etc.
Yeah, I think the thing that I'm most excited about is that with the ability to move assets instantly on chain anywhere in the world, we're now seeing the growth of the first ever global fintech companies. Historically, fintech was a very regional category, and we're seeing that emerge across a number of different areas. The earliest iterations, I think, have been some of the consumer fintech payments apps. I think we're going to see B2B fintechs that are built that are just able to serve a global audience. And I think that this could lead to the largest fintech companies to ever be built, because they can access a global addressable market.
Awesome. Thank you, everyone. Hopefully this is a good sign of all the opportunities out there that happen in like any phase of the cycle. And it seems like we're getting on a positive note here. So
Thank you.
thank you.
Thank you for moderating.